Hello fellow Ghost Traders, welcome to the weekly market update for 10/22/2023. Another busy week in the markets expected. Big tech started off on the wrong foot as Tesla slid more than 9% on Thursday, following a pessimistic economic outlook from CEO Elon Musk during the company's earnings call. Add to that the slew of negative international news as the war in the Middle East looks to expand rapidly, calling up as many as 12,000 U.S. service members into deployment. Other countries in the Middle East are adding fuel to the conflict, including Syria, Iran, and Iraq. Look to this escalation to weigh heavily on the markets, more so than the Ukraine conflict that's been going on for the last 2 years. Most Americans, over 60%, have strong sentiment about the conflict in the Middle East. Weaker than expected economic numbers are causing investors to worry that earnings may not go as strongly as expected. The CNN Fear Greed Index shows investors poised to drop into extreme fear mode this week if the market continues its bearish slide. Wall Street notched a losing week on Friday. The S&P posted its first loss in 3 weeks, while the Dow Jones Industrial Average notched its third losing week in the last 4. This comes as the 10-year Treasury yield breached a 5% psychological level. It is likely to breach it again later this week. Companies expect to only see a modest October improvement over September, which was a terrible month for bulls in the market. Holiday and promotional patterns indicate a more conservative than usual movement in sales. This will likely lead to an increase in negative revisions for the fourth quarter and a likely pause of potential raises. Wholesale generally lags behind retail. However, wholesalers will need to begin replenishing supplies, possibly bolstering their payouts. On a positive note, Ghost Trade Shadow posted 100% winners on their trades and ended the week at 2.98% return on risk. We can look forward to a slew of economic reports this coming week ahead of the October 31 Fed policy meeting. Markets are confident that the Fed will keep interest rates at current levels. However, it is uncertain what central banks will do in the December-January timeframe, where another rate hike is likely. It is extremely unlikely that any rate cuts will happen until late 2024, if even then. Tuesday, we have the S&P Global PMI Composite, the PMI Manufacturing, and PMI Services due out. Wednesday, watch for the new home sales report. Thursday, the durable goods report, Q3 GDP, and wholesale preliminaries report. Friday, the personal consumption expenditure and the personal income reports, which are, by and large, the Fed's preferred inflation gauge. It is expected to have a slightly higher than expected reading. It's too early to tell how the earnings season will turn out, but this week may be a solid indication of how the rest of the week will play. Major earnings announcements this week as follows. Tuesday, Alphabet, Microsoft, Visa, Texas Instruments, General Motors, and Coca-Cola. Wednesday, Hilton, General Dynamics, Meta, and IBM. Thursday, PG&E, MasterCard, Amazon, Royal Caribbean, UPS, Comcast, Ford Motor, Chipotle, and Enphase. And of course, Friday, Phillips 66, Chevron, Exxon, and Colgate. So far, earnings remain fairly strong despite some disappointment, yet the market is not responding positively and is acting as if they expect the economy to continue slowing. A few upcoming earnings to consider. HSBC gives Hilton, Marriott, and Royal Caribbean a buy rating. Defense stock L3 Harris, LHX, has been given the nod by several analysts. Many analysts believe Eli Lilly has another 15% upside, as 10% of obese patients not on Medicare are expected to be placed on the drug. Look for oil stocks to benefit from the turmoil around the world, as demand will continue to stay strong, even increase over the next few months, while supply will likely tighten. SolarEdge plunged last week, hurting other stocks in the solar arena. The consensus is that the swing went too far and there is a likely bounce back in the near future. Some analysts believe SEDG may have cut pricing in late Q3 and extended favorable terms to suppliers in an effort to win back share from lower price competitors to which it lost market share year to date. These pricing changes were slated for 2024 but appear to have been implemented sooner. That's it for the week's weekly update. Keep an eye out for great earnings potential and get ready for Thursday and Friday shadow trades. Have a great week in the markets, play it safe for the near future, and make today your masterpiece. Until next time.